The Federal Reserve just came out with their outlook for 2026, and they're only expecting one interest rate cut for the entire year. This came out right after they cut interest rates by another 0.25% on December 10th. I'm taking this rate cut outlook as a good thing because Jerome Powell's term ends in May and the president will be replacing him with somebody else. And I mean, it'll only make sense for him to put somebody else that wants to cut interest rates aggressively because it's what the president wants to see. President Trump has just stated that he wants to see interest rates as low as 1% and even lower. So with that said, if they're saying that they're only expecting one interest rate cut next year right now, then the market has only priced in one rate cut for the year. But if you believe that we're likely to see much more than that after Jerome Powell leaves, then it will start to price in more and more rate cut at future Federal Reserve meetings. And I don't know about you, but I do like to buy my stocks a little cheaper before they explode. As far as Jerome Powell's successor, it's looking like it's going to be Kevin Hassett or Kevin Warsh next in line. And whoever it is, I'll be doing a deep dive video on them so that we can see exactly who they are and what we should expect during their term. So subscribe and stay tuned for that video. And with all that said, I'm expecting next year to be a great year for assets, just like this year. I think that it'll start off a bit rocky, but I'll be buying during those times as I usually do. I'll continue to buy anytime that I see the market is in extreme fear levels on the Fear and Greed Index. But as of right now, let's take a look at the next Federal Reserve meeting and what the market has priced in so far when it comes to interest rates. According to the CME Fed tool, there's only a 24% chance of a rate cut in January and a 76% chance of the Fed to leave them alone. But if we see that employment data is getting worse or inflation is getting better, then we'll see these numbers go up quite a bit. Because as you may know, the Federal Reserve has a dual mandate, which are maximum employment
and stable prices for the benefit of the American people.
So since we know that those are their primary goals and they have the power to help one or the other, then we can use the data that's coming in to our benefit. Interest rate cuts are a good thing for the stock market, and we know that the only reason why they've been cutting interest rates is because of the labor market issues that's been happening in the US all year. With that said, employment data is getting worse, with the unemployment rate increasing to 4.4% in September. And of course, we won't be seeing how bad the employment data was for the entire month of October. And that's because the government was closed for that month. But will this recent rate cut do the trick? Will it completely fix the broken job market that's been intensifying this year? Well, a Bloomberg report just came out and it says that the battle may take longer than they thought because Thursday's unemployment claims are among the highest readings seen for the year, and companies like Pepsi and HP have laid out plans to fire employees in recent weeks. Nationwide terminations in October were also at the highest level seen since 2023. The Federal Reserve has been saying that the job market is cooling, but according to the data, it's showing the complete opposite. We'll see more data coming out next week with ADP employment change coming out on Tuesday and CPI inflation coming out on Thursday. And with those two coming out, we'll have a clear picture of how the economy is actually doing, especially since we didn't get a lot of data from October. Interest rates aside, let's talk about everything else that's been happening in the stock market. The market right now is back at all-time highs, as you may already know. And of course, in true fashion, all the AI bubble talks have now faded. Nobody is talking about it now. Wonder why? But one thing that I will say is that when everybody was talking about it, they've raised some real issues and concerns. And it's something to not overlook. It doesn't mean that there was a bubble, and I still don't believe there's one right now. It just shows that there's going to be winners and some losers in this whole thing. If you take a look at this diagram, it's the open AI circle, and I'm sure you've seen it. Oracle, for example, they've been getting slammed lately, dropping as low as 45% from its all-time highs. The revenue has been growing quite rapidly, however, they've been bleeding through their free cash flow, and it's now turned negative over the past year. And that happened because they've been investing heavily in building more AI data centers and infrastructure surrounding AI. And even similarly is CoreWeave, except what puts them in a worse position is that the amount of debt that they're in, and it's only been increasing over time. They've also came out saying that their data centers will be delayed, so this made their stock drop nearly 60% in just a few months. But what do I think will happen in 2026? As I mentioned earlier, it'll be a great year for asset owners just like it was this year, but I wouldn't be surprised if a market correction happens in the first and second quarter of the year. Expect a lot of volatility before and after the new Fed chairman comes in and as the tariff situation with the Supreme Court gets finalized. And no, I'm not saying to sell everything, because I won't be doing that myself and I don't think anybody else should do it. But what I am saying is that I'll be putting capital aside from what I'm making in my career so that I can buy more assets if that time does come. It's just like I did in March and April, and just like I did last month. In fact, I haven't been posting much lately because I've been working 60 to 80 hours a week so that I can do just that. You don't have to get ready if you stay ready. I've also been thinking, and I hope it doesn't happen, is that just how the tariffs were used this year and it created a lot of volatility in the stock market, well, next year, I wouldn't be surprised if interest rates were used in the same fashion. And that's because the president says that they should drop interest rates rapidly towards 1%, and if inflation spikes up, which will most likely happen, then they can just increase interest rates back up on a drop of a dime. And yeah, all that is true, but man, the stock market will be extremely unstable. Hopefully it doesn't happen like that, but we'll see how it all plays out. And of course, I'll be keeping you posted through it all.